English for Financial Institutions. By Karol Siskind. Part 4. Securities and Investment. Unit 13. Equity securities. Ordinary and preference shares. Equity securities, also known as equities, are issued by companies to raise the funds needed to start and maintain their operation. The partial interest in the company that investors receive in exchange for their funds usually takes the form of shares in the company. In the past, paper certificates documenting the ownership of shares were issued, but they have been largely replaced by dematerialized, electronic records. Most retail investors use brokers to buy and sell shares, and these shares are usually held in the broker's name, on a nominee account, or in street name, as it is also known. Ordinary shares are the most common form of equities. Acquiring ordinary shares gives the holder certain legal rights, such as the right to vote at shareholders' meetings, and the right to receive dividends. The payment of dividends, which is announced by the board of directors of a company, depends primarily on profitability. Many U.S. companies pay dividends on a quarterly basis, while in other countries, annual payments are typical. Shareholders who are registered owners of the shares on the date of record receive the dividend payment. Some companies issue different classes of ordinary shares, often designated as Class A and Class B shares, which generally differ by voting privileges. Although there are no standard definitions, Class B shares usually give its holder more votes per share compared to Class A. Some holders of ordinary shares also receive preemptive rights, which enable them to retain their proportional ownership in a company should it issue another stock offering. Preference shares are equity securities that are similar to bonds in certain ways. They provide a fixed dividend payment, their market value is sensitive to changes in interest rates, and are rated by credit rating agencies. Unlike ordinary shares, preference shares do not usually carry voting rights. Preferred shareholders have priority over ordinary shareholders for dividends and for the proceeds of liquidation if the company fails. However, dividends on preference shares are not guaranteed, which explains why it is often the case that companies issue preferred stock when experiencing financial problems, as the issue provides capital, but does not obligate a company to future payments as in the case of bonds. Rights offering. A rights offering is a type of secondary offering, in which a company sells new shares in order to raise capital. Shares are offered to the existing shareholders of a company in proportion to the shares they already own, usually at a discount to the market price, which gives them an incentive to buy the new shares. A rights offering allows existing shareholders to avoid the dilution of their shares, thus they can decide if they wish to exercise their rights by paying the discounted issue price and receiving the shares, or to sell the rights to other buyers in the market. A stockholder usually receives one right for each stock owned at the rights date of record. Depending on the ratio, a certain number of rights entitles the holder to purchase one new share. For instance, if the ratio is 1:5, an existing investor can buy one extra share for every 5 rights. When a rights issue is announced, there is a period during which the stock will trade rights with rights. That is, the rights are embedded in the stock. At the end of this period, all stockholders of record receive their rights. This is followed by a period when the rights are detached from the stock and trade separately, which is known as trading rights, without rights. This period typically lasts several weeks, after which the rights expire. Warrants. A warrant is a security that is attached to preferred stocks and corporate bonds. It allows the holder to purchase a specified number of shares of the issuing company during a given time period. These shares can be bought at a price, called the exercise price, that is usually above the current market price at the time of issuance. Therefore, warrants may be seen as an attractive investment when they are issued by growth companies. When warrants are issued, they initially trade as a unit with the underlying security for a certain period of time, after which they usually separate into two instruments traded independently. Warrants are similar to call options, as both give the right to buy stock at a specified price at a future time. However, warrants have a longer lifetime than options, even up to 20 years, and are not standardized, which is why they are generally traded over the counter. The incentive of potential future profit for investors allows the companies issuing warrants to offer a lower rate of interest or dividends compared to securities issued without warrants. There is also a type of warrant called a covered or naked warrant, which is issued by financial institutions without an accompanying security. They are traded on exchanges and have a broad range of underlying assets, such as equities, commodities, indices, and currencies. Moreover, covered warrants give the right to buy or sell an asset, call and put warrants, thus they resemble options to an even greater degree than traditional warrants. One important difference is that covered warrants are easier to access for individuals as they can be bought and sold in the same way as other securities on the stock exchange. Depositary receipts. Depositary receipts are negotiable securities that allow individuals and institutions to invest in foreign companies. Buying shares directly in foreign markets can be complicated due to cross-currency transactions, possible restrictions on the flow of capital, tax issues, and changing regulatory procedures. For this reason, depositary receipts were developed as a means of avoiding these problems, as well as enabling companies to raise capital in international markets. A company that is listed on its domestic stock exchange may deposit a certain number of shares with a foreign bank, known as the depositary bank. The bank then issues depositary receipts representing an ownership interest in the shares. These receipts can be traded independently from the underlying shares, either on an exchange or in the over-the-counter market. Investors purchasing depositary receipts hold the same privileges as shareholders of common shares, such as dividends and voting rights. The most popular types of depositary receipts are American Depositary Receipts, ADRs, which are traded on U.S. stock exchanges, and Global Depositary Receipts, GDRs, which are commonly listed on European exchanges. Both are usually denominated in US dollars, but can also be denominated in euros. These instruments are frequently used by companies from emerging markets, although it is not uncommon for companies from established markets, such as the UK or Germany, to arrange an issue of ADRs in the US. Unit 14. Bonds. Characteristics. Bonds are a type of financial instrument called debt securities. The issuer of such securities borrows money from investors in exchange for fixed interest payments. Therefore, these instruments are often called fixed-income securities. Debt securities can be classified into money market instruments, with a maturity of less than 1 year, and bonds, with a maturity usually up to 50 years. A typical bond obliges the issuer to make payments to the bondholder until its maturity date. These payments are known as coupon payments, as bonds used to have coupons that were detached in order to receive interest. The amount of interest paid annually, expressed as a percentage of the face value, is called the coupon rate. On the maturity date, the issuer repays the principal, par or face value. From the time a bond is issued until the day it matures, its price in the market will fluctuate depending on the particular terms of that bond as well as prevailing interest rates and other factors, including credit risk. This is the risk that the issuer will default or be unable to make further principal or interest payments. It is measured by credit rating agencies in the form of ratings assigned to bond issues. High and medium quality bonds, in terms of creditworthiness, are classified as investment grade, while lower rated bonds are known as speculative grade, or junk bonds. Their higher credit risk means that junk bond yields are higher than yields on bonds of better credit quality, which is why junk bonds are also known by the euphemistic term high-yield bonds. Types of bonds according to provisions and interest payment. Certain bonds have options embedded in them, providing the issuer or holder with additional rights. Callable bonds include a provision stating that the issuer has the right to call, redeem, the bond, that is to sell it back to the holder. In the case of European callable bonds, early redemption may be restricted to a specified date, while American callables may be redeemed at any time prior to maturity. Puttable bonds have an opposite feature: they give the bondholder the right to demand early payment of the par value, usually on specified dates. Convertible bonds are debt instruments that can be converted into ordinary shares of the issuing company at the discretion of the bondholder. One type of bonds, called zero-coupon bonds, make no coupon payments. The holder receives the par value at maturity and the investor's return results from the difference between the purchase price and the par value. Another type of bonds, called perpetual bonds, have no maturity date, which means that, in theory, coupon payments are made forever. In practice, however, the format for a perpetual bond is usually that of a callable bond, although some cannot be called for a specified number of years. Floating rate bonds have coupon rates which vary over a bond's lifetime. Generally, the floating coupon rate is set at a premium over a reference rate and is reset on a pre-specified basis, usually several times a year. For index-linked bonds, coupons and/or principals grow in line with inflation, thus preserving the real value of capital invested. Types of bonds according to issuer. Government bonds are issued by many countries around the world to finance public debt. In the US, such instruments are called Treasury securities, and a distinction is made between Treasury notes and bonds. Treasury notes are issued with maturities ranging from 2 to 10 years, while Treasury bonds have a maturity of either 20 or 30 years. UK government securities are called gilts. These include two types: conventional gilts, with fixed semi-annual coupon payments and a maturity of up to 50 years, and index-linked gilts. From an investor's perspective, government bonds are relatively safe instruments, although in recent years a number of countries have defaulted on their bonds. Corporate bonds are issued by large companies when they need long-term financing. In the US, these bonds are commonly issued in denominations of $1,000. Most corporate bonds are unsecured, that is, they are backed only by the general creditworthiness of the issuer. A long-term unsecured corporate bond is known as a debenture. In the case of secured bonds, the issuer has pledged specific assets, known as collateral, that can be sold, if necessary, to pay the bondholders. Municipal bonds are issued by local or regional governments to finance public interest projects, usually related to the development of infrastructure. These instruments are especially popular in the US, as they are largely exempt from taxation. The two basic types of municipal bonds are general obligation bonds, which are paid from taxes or general revenue collected by the issuing government, and revenue bonds, which are paid from the revenue generated by a particular project, such as a tunnel or bridge. International bonds include foreign bonds, Eurobonds, and supranational bonds. A foreign bond is issued by a borrower in a country different from the borrower's country. For example, a Canadian company may issue bonds in the United States denominated in US dollars. This type of bond is called a Yankee bond, while a sterling-denominated bond issued in the UK by a non-British company is called a bulldog bond. Eurobonds are denominated in the currency of one country, but sold or traded in another country. For example, a Eurodollar bond is denominated in dollars but sold outside the US, not necessarily in Europe. Supranational bonds are issued by international financial institutions, IFIs, such as the World Bank or European Investment Bank. in order to finance projects or provide financial assistance to national governments. Asset-backed securities, ABS, are a category of debt securities that differ from typical bonds in that interest and principal payments are backed by underlying cash flows from other assets, loans and receivables. These assets are pooled into large portfolios and securitized, that is converted into securities that can be sold to investors. The source of assets may be quite exotic, as in the case of David Bowie bonds, which were issued in 1997 with payments tied to the royalties on the singer's albums. Unit 15. Derivatives. Overview. A derivative is a financial instrument whose value derives from the value of an underlying asset, such as commodities, securities, or market variables, for example indices or exchange rates. Formally speaking, it is a contract between two or more parties, with a fixed expiration date, usually between 3 and 12 months. Derivatives enable financial institutions to hedge, that is, engage in a transaction that reduces or eliminates the risk associated with adverse price movements. However, the capacity of derivatives markets to provide hedging depends on the availability of speculators to act as counterparties to hedgers. In the hopes of making short-term profits, speculators assume the risk of price movements that hedgers seek to avoid. An important feature of derivatives is that they allow their users to obtain leverage. With a relatively small outlay, the investor is able to take a large position in the market. The major categories of derivatives are forwards, futures, options, and swaps. Forwards and futures. A forward contract is an agreement between two parties in which the seller agrees to deliver to the buyer a specified quantity and quality of an asset or commodity at a specified future date at a predetermined price. A forward contract can be distinguished from a spot contract, that is, a contract for immediate delivery of the commodity. A forward contract is typically a privately negotiated bilateral contract that is not conducted on an organized marketplace or exchange, thus there is no secondary market for it. Apart from commodities, forwards are conducted for the purchase of foreign exchange, FX forwards, and for interest rates. One example of the latter type of forward contract, known as a forward rate agreement, FRA, is used by companies or financial institutions to lock in an interest rate for money that will be lent or borrowed in the future, usually within 12 months. Futures are contracts that follow the same basic principle of delivering an asset on a specified future date, but with a number of key differences. Firstly, futures are standardized, that is, the contract specifies the underlying asset size or value, delivery date, as well as acceptable grade and place of delivery in the case of commodities. Standardization allows futures to be traded on organized exchanges, thus enhancing liquidity. Furthermore, futures contracts are marked to market at the end of every trading day. This means that the change in value of a contract is added or subtracted from the margin account of traders on the exchange. All futures contracts are conducted through a clearing house, which acts as an intermediary and counterparty for each side of the contract. The clearing house may be an independent entity serving an exchange, or its role may be performed by the exchange itself, as with the Chicago Mercantile Exchange, the largest derivatives exchange in the world. Futures differ from other securities in that they are not bought or sold, but entered into by mutual agreement. The party committing to purchase the asset on the delivery date takes what is known as the long position, while a short position commits to delivering it on that date. However, in the case of futures it is common for the parties of the contract to close out their positions before the delivery date, by carrying out a reversing trade, for example entering a long position to offset a short position. The price that is quoted in newspapers or electronic listings is the settlement price at the end of trading at an exchange. This price is useful for investors as it is advance indication of the price likely to prevail for a given asset in the future. Options. Options are contracts that give the purchaser the right to buy or sell the underlying asset at a specific price, called the exercise price or strike price. Call options confer the right to buy the underlying asset, while a put option gives its holder the right to sell the asset. This purchase or sale may take place on the expiration date, European options, or at any time up until the expiration date, American options. If the option is not exercised, that is, the holder does not make use of his right, the option expires, it becomes void and loses its value. The price paid to acquire an option is called the premium, which represents its current market price. The premium, which is usually only a small fraction of the overall value of the traded asset, is paid up front to the seller, called the writer of the option. The option writer keeps the full amount even if the option is not exercised. When exercising an option would be profitable for the holder, it is described as in the money. Thus, a call contract is in the money if the price of the underlying asset is higher than the option's contract strike price. Conversely, a put contract is in the money if the price of the underlying asset is lower than the option's contract strike price. Thus, profits on call options increase as the asset increases in value, while profits on put options increase when the asset value falls. Many types of options, for example stock, index, FX options, are traded on exchanges, where asset classes, expiration dates and exercise prices are standardized. Others are traded over the counter, which enables the customization of contracts to the specific needs of both counterparties. However, OTC options are subject to counterparty risk, as there is no clearing house to protect a party if its counterparty defaults. Swaps. Swaps are over-the-counter financial contracts in which two counterparties exchange streams of payments over a certain period of time. The most common type is an interest rate swap, where fixed interest rate payments are exchanged for floating rate payments. The interest payments are calculated on a notional amount, and a reference rate, such as LIBOR, is used as the base for the floating rate. A currency swap involves exchanging principal and/or interest payments on a loan in one currency for payments on a similar loan in another currency. Interest rate and currency swaps are used as financial tools to protect companies against rate volatility, and to lower the amount needed to service a debt. A credit default swap, CDS, despite its name, significantly differs from the above types of swaps. It is a form of insurance, used for hedging credit exposure to an asset or issuer. The buyer of the contract makes periodic payments, known as the CDS spread or premium, to the protection seller and in return receives the par value of a bond or loan if a credit event occurs. The value of CDS spreads reflects market perceptions of the financial health of corporate and sovereign debt issuers, and therefore these spreads are closely observed by market participants. Unit 16. Private equity. Private equity firms and funds. Private equity, PE, is the investment in equity capital in private companies, that is, companies not listed on a stock exchange. In practical terms, this involves a group of investors buying a stake in a private company with the hope of increasing the value of that stake, and selling it for a profit. The process starts with a private equity firm, which possesses specialized business expertise and a network of industry contacts. PE firms raise capital for investments by establishing a private equity fund, which usually takes the form of a limited partnership. The PE firm acts as general partner of the fund, and it seeks out external investors, such as pension funds, insurance companies, banks, endowments, foundations, and affluent individuals who commit a certain amount of capital and thus become the fund's limited partners. The general partner makes all of the decisions about the private equity fund and is also in charge of managing the fund's portfolio, which contains all of the fund's investments. Most private equity funds are closed-end funds, which means that the limited partners cannot withdraw their funds until the fund is terminated. The general partner uses the money obtained from limited partners, along with funds borrowed from banks and other lenders, to acquire companies or business units that have the potential to achieve significantly higher growth and profitability. In order to fulfill that potential, the general partner may completely restructure the company, change its business strategy, add new products and discontinue others. If the target company is a public company, ownership is transferred from its shareholders to a smaller number of private owners. Many PE firms replace the incumbent management with their own operating partners, executives who have experience running a company in a particular sector. When the target company's value has been maximized, the PE fund will liquidate its investment through a chosen exit strategy. The most common include selling the company's stock in an initial public offering, selling the company to a strategic buyer, or to the company's management. The capital gains achieved by the fund are distributed to the limited partners on a pro rata basis, while the general partners receive a certain percentage, typically 20%, of the proceeds, which is known as carried interest. The general partner will also earn income from an annual management fee, usually 1% to 2% of the capital committed, charged to each limited partner. For investors, private equity provides an alternative asset class with the potential for superior returns and portfolio diversification. Leveraged buyouts. One of the most common investment strategies used by private equity funds is the leveraged buyout, LBO. It is a transaction in which a company or business unit is purchased with the use of financial leverage, that is, with a significant amount of borrowed money. This usually takes the form of syndicated loans, a loan provided by a group of lenders, a syndicate, who pool their funds for a single borrower, and high-yield bonds issued by the PE firm. A portion of the debt is secured by the assets of the target company. Cash flows generated through the company's operations are used to make principal and interest payments within the maturity of the project. LBOs are primarily conducted in established industries where companies generate high and steady cash flows, and have assets that can easily be pledged as collateral. Most large LBO deals are completed in an auction process conducted by investment bankers to attract the highest bid. Reasons for LBOs include the financing of corporate expansions, consolidations, turnarounds or sales of divisions or subsidiaries. Venture capital. Venture capital refers to equity investments in startup companies to assist with their development and expansion, particularly in high-technology sectors. This enables entrepreneurs who would otherwise not have access to the funding necessary to develop innovative products or new business ideas. The investors providing the capital are attracted by the potential of very high returns if the business plans prove successful. However, the level of associated risk is also high. It is accepted that a majority of companies receiving financing will fail or merely return their investment. Therefore, successful investments are expected to cover imminent losses and still provide sufficient returns for investors. Private equity firms or specialized venture capital firms take an equity or ownership stake in the company, usually in the form of preference shares, convertible into common shares of the company, and one or more seats on the board of directors. Venture capital is sometimes classified according to the stage of development of the company seeking financing. Seed capital, or seed investment, refers to funds that are provided to entrepreneurs to transform promising business ideas into reality, which involves financing a number of preliminary activities, for example market research, the purchase of equipment, developing a prototype. When a company has performed studies and research into their chosen market and is ready to launch their product or service, it may require startup capital to carry out an initial marketing push, helping to distribute a product in the market. Other private equity investment strategies. Growth capital refers to minority equity investments in mature companies that is successfully operating for a number of years, that require capital for expansion or restructuring their operations. The funds may be used to finance an acquisition, enter a new market, or reduce the level of leverage. The investment risk is lower compared to venture capital, thus the required rates of return by private equity portfolio managers are also lower. Mezzanine capital, mezzanine finance, is a form of financing that combines the features of debt and equity. The most common form of mezzanine finance is a subordinated loan, which is an unsecured loan with lower ranking in case of bankruptcy compared to senior debt. In return for their increased risk, subordinated lenders receive interest on the loan as well as additional yield enhancements, such as stock warrants that allow the debt investor to purchase common shares of the company and achieve returns if the value of its equity increases. There are many other mezzanine instruments, for example convertible bonds, profit participation, which similarly give investors the opportunity to receive a stake in a company's upside potential. Mezzanine capital is provided to companies in various stages of their life cycle for a number of purposes, such as financing business expansion, acquisitions, and construction projects. Part 5. Financial Markets. Unit 17. Foreign exchange market. Exchange rates. An exchange rate is the price of one currency, called the base currency, expressed in terms of another currency, the counter or quote currency. The value of the base currency is always 1. Therefore, the exchange rate tells us how much of the counter currency corresponds to 1 unit of the base currency. For example, an exchange rate for euro to US dollar of 1.3245 signifies that 1 euro is worth 1.3245 US dollars. A speculator would buy the base currency if he or she expects it will appreciate relative to the quote currency, and would sell the base currency if it was anticipated to depreciate relative to the quote currency. Most currencies are quoted to 4 decimal places. The smallest price movement used in trading is called a pip, which is equal to 1/100%, or 0.0001 of 1 unit of currency. For each currency pair, 2 rates are offered, the bid rate, at which a currency can be bought, and the ask rate, at which a currency can be sold. The middle rate is the midpoint between the bid and ask rates. Most currencies in the world are quoted against the US dollar or euro, as the market for less popular currency pairs, for example Tajikistani simoni or Uruguayan peso, is very thin and illiquid. This would entail high transaction costs. To avoid this, the first currency is exchanged into US dollars, which are then exchanged into the second currency. This is how a cross rate is obtained, the exchange rate of 2 currencies that are expressed in terms of a third currency. Types of FX transactions. A spot transaction is the exchange of one currency for another, with delivery and payment taking place within 2 business days. In the case of an FX forward, delivery and payment of the currencies take place at a future date, but at a price agreed at the time the contract is made. The forward rate is generally expressed by showing the amount by which it diverges from the spot rate. If the forward rate is higher than the spot rate, it is at a forward premium. If it is lower than the spot rate, it is at a forward discount to the other currency. An FX swap is a transaction in which one party borrows one currency from, and simultaneously lends another currency to the second party. Each party uses the repayment obligation to its counterparty as collateral, and the amount of repayment is fixed at the FX forward rate as of the start of the contract. Thus the repayment consists of a reverse exchange of currencies. Such swaps are often used by banks to balance their currency positions. This is different from a currency swap, where 2 counterparties agree to exchange streams of interest payments and/or principal payments of a loan in different currencies. Currency futures and options are also an important form of FX transactions. Carry trades are currency trades designed to capitalize on the difference between interest rates offered for two currencies. Under the strategy, investors borrow a currency with a low interest rate and use the funds to invest, lend, in a currency with a higher interest rate. A famous example was the yen carry trade, made possible by the relatively large interest rate differential between the US dollar and the Japanese yen. FX trading. The main characteristic of FX trading is the fact that it is highly decentralized. Trading largely takes place outside regulated exchanges, with the exception of standardized futures and option contracts, on an over-the-counter basis, with the use of electronic trading platforms. The main participants in the market are large international banks, which act as market makers by buying currencies from and selling to their clients. These banks also engage in proprietary trading, with the purpose of making profits on behalf of the bank itself. The bulk of trading is conducted in wholesale amounts, that is $1 million or more per trade. The standard contract size used in trading is known as a lot, which represents 100,000 units of a currency. One consequence of the decentralized nature of FX trading is that there is not a single exchange rate, but rather a number of different rates offered by various banks or market makers. This feature makes it possible to apply a strategy known as currency arbitrage, which takes advantage of temporary discrepancies in currency rates. Forex traders practice two-currency arbitrage, in which the differences between the spreads of two currencies are exploited. A more sophisticated variant is three-currency arbitrage, also known as triangular arbitrage. Foreign exchange controls. Although most developed countries allow their currencies to float freely, or within certain limits, there are many countries in the world which impose restrictions on trading foreign currencies or on trading their local currency. Some countries use a fixed exchange rate, where the rate is pegged to another currency, for example the US dollar or euro. In order to maintain a stable rate, the central bank of the country must hold large reserves of foreign currency to mitigate changes in supply and demand. Another measure used by some governments is to limit the convertibility of a local currency. This may be done by rationing the amount of foreign currency available for exchange, in order to maintain the official exchange rate at a higher level than supply and demand would dictate. For example, private persons as well as local companies may be required to sell foreign currency coming into their possession to a central bank, or specialized government agency at exchange rates set by the government. Unit 18. Money markets. Description and functions. Money markets are wholesale financial markets in which debt instruments with maturities of up to 1 year are bought and sold. Most of these securities are issued in large denominations and are therefore normally out of the reach of retail investors. In the money market, the surplus funds are parked, that is invested in near money assets which are highly liquid and can be easily converted into cash. This allows institutions to earn profits without sacrificing liquidity. Conversely, money markets provide companies and financial institutions a source of funds for short periods. The core money markets are interbank markets, in which commercial banks lend to and borrow from one another as part of their liquidity management. Central banks conduct open market operations on the money markets in order to control money supply and short-term interest rates. Companies may secure short-term funding to meet their working capital requirements by issuing negotiable debt instruments. Money market instruments. A repurchase agreement, repo, is a transaction in which one party sells an asset, usually fixed-income securities, to another party at one price and commits to repurchase the asset from the second party at a higher price at a future date. The transaction serves as a short-term loan to the seller, and the asset acts as collateral. Due to the fact that the value of collateral may fluctuate, the buying party usually imposes a haircut, that is, a certain percentage is deducted from the market value of the collateral. Commercial paper is an unsecured debt instrument that pays a fixed rate of interest. It is typically issued by large banks or corporations, especially in the US, to cover short-term financial obligations, although many issuers continuously roll over their commercial paper. Since it is not backed by collateral, only the largest and most creditworthy companies and banks issue this type of instrument. Treasury bills are short-term debt securities issued by national governments or their agencies to finance budget needs. Like zero-coupon bonds, they are usually sold at a discount from face value at regular auctions. Treasury bills in many countries are accessible to retail investors. For example, in the US the minimum denomination is $100. A certificate of deposit, CD, is a time deposit with a bank, usually issued in high denominations. Holders of CDs receive interest and principal only at the end of the fixed term of the CD, or face a penalty if they redeemed before the maturity date. However, negotiable CDs can be traded in the secondary market, and the purchaser gains the right to collect the amount due at maturity. Euro currency is a time deposit, not necessarily in euros, at a bank outside the jurisdiction of the country that issued the currency, for example a deposit made in yen in a UK bank. Banks offering euro currency deposits are therefore not subject to the regulations of the issuing country, such as the reserve requirement, and may thus pay higher interest rates on deposits and charge lower interest on euro currency loans. A banker's acceptance is an order to pay a certain amount of money to the bearer on a given date. It is widely used in international trade for payments that are due for a shipment of goods at a future date. Instead of holding the acceptance until maturity, the bearer may decide to sell the banker's acceptance in the secondary market, as it is backed by the credit of the bank. Acceptances are sold on a discounted basis. Another type of instrument originating in international trade is a bill of exchange. It is a document which commits the buyer of goods to pay a certain amount to the seller on a due date. As with a banker's acceptance, the seller may hold it until maturity or sell it at a discount in the secondary market. Money market funds and accounts. A money market fund is an open-ended investment fund that invests in money market instruments. Unlike most other investment funds, money market funds have no loads, that is, they do not charge fees for entering or exiting the fund. From an investor's perspective, holding shares of money market funds is similar to holding cash, because investors can withdraw money from a fund at a moment's notice. Money market funds are a preferred vehicle for cash management for many types of corporations and institutions, as such funds provide a high degree of liquidity, diversification, and stability of value, which is combined with a market-based yield. These qualities are also attractive to some retail investors. Some money market funds, especially in the US, aim to maintain a constant net asset value, NAV, or value of a share of the fund, at for example $1 when investors purchase or redeem shares, interest is paid as a dividend. Other money market funds offer variable NAV, that is, redemptions and subscriptions are offered at a price equal to the fund's NAV per share. A money market account is a type of demand deposit account offered by banks. Funds deposited by clients are invested in money market instruments. Banks offer a higher interest rate for such accounts by requiring a higher minimum balance, and by placing restrictions on the number of withdrawals the account holder may take over a given period of time. Thanks to their competitive interest rate, money market accounts are regarded by some as an alternative to demand deposits or savings accounts. Unit 19. Stock markets. Trading mechanisms. Until the 1990s, the most common way to trade securities on stock markets was open outcry trading, which takes place on the trading floor of an exchange. Using this method, securities are bought and sold by traders using verbal or hand signals to convey information such as price or quantity. Open outcry trading has been largely replaced by electronic trading, but it's still used to a small extent, for example on the New York Stock Exchange. Most of the major securities exchanges around the world are order-driven markets. In this type of trading, buyers and sellers trade with each other directly without the intermediation of dealers. The trading is conducted in the form of a continuous auction, where prices are determined by matching orders to buy and sell securities. Trades are arranged based on certain rules, for example price priority, which means that the lowest sell and highest buy orders take precedence over other orders. In the case of quote-driven, or dealer, markets, there are dealers, market makers, who build up an inventory of assets by purchasing them on their own account. These assets are then sold, and the spread between the bid, buy, and ask, sell, price is the source of profit for dealers. An example of a dealer-driven market is Nasdaq, a stock exchange where trading takes place through an electronic network rather than in one central location. One should be aware, however, that many stock exchanges, including the New York Stock Exchange and Nasdaq, are hybrid markets which combine the features of order and quote-driven markets. In recent years, alternative trading platforms have grown in importance. Known as multilateral trading facilities, or electronic communications networks in the US, they have taken over a large share of trading from traditional stock markets thanks to lower transaction costs and modern technology. At present, the shares of companies listed on traditional exchanges may be traded concurrently on a large number of alternative venues. Trading strategies. Day trading, as opposed to buy-and-hold investing, is the speculative buying and selling of securities within a single trading day. Day traders use high amounts of leverage and short-term trading strategies to capitalize on small price movements in highly liquid assets. One of the techniques they use is short selling, where a trader borrows a security, paying a commission to a broker, in anticipation of a drop in its price. The trader sells the security, and if indeed the price falls, a profit will be made by purchasing the same security for a lower price. In the case of naked short selling, the trader sells a security without first borrowing it. This is done with the expectation that its price will quickly fall, letting the seller repurchase it at a lower price and then deliver the stock to the buyer. In many jurisdictions, naked short selling is partially or completely forbidden. High-frequency trading, HFT, is a type of automated trading that has been gaining importance in recent years. HFT firms use ultra-fast computers and powerful algorithms, which execute millions of orders per second and scan numerous markets simultaneously. Thanks to extremely high trading volumes, even very low profit margins, for example 1 cent per trade, turn into huge profits. HFT now accounts for more than half of all equity trading in the US and around 1/3 in Europe. Bubbles and crashes. A price bubble is a surge in the price of a given asset, for example securities, commodities, real estate, as a result of massive demand from investors. This may be the result of psychological factors, such as herd behavior, which causes prices to rise above fundamental value. One example of a bubble is the dot-com bubble of 1999 to 2000, during which share prices of internet startup companies rose to highly inflated levels before suddenly collapsing. The bursting of a bubble may lead to a stock market crash or economic crisis. A stock market crash is characterized by a sell-off of shares, or other securities, which causes share prices to decline rapidly. Prices often remain depressed for months or even years, and investors suffer large losses, especially if they were buying on margin. Crashes are often followed by a recession or depression. The Great Depression of the 1930s was triggered by the U.S. stock market crash of 1929. In more recent times, 2010, a new type of crash appeared. Known as a flash crash, it was a large drop in the Dow Jones Industrial Average that occurred in a matter of minutes, before prices returned to previous levels just as quickly. Although the definitive cause is still unclear, high-frequency trading is thought to have contributed to the abrupt nature of the crash. In order to prevent panic selling and potential flash crashes, stock exchanges have introduced rules known as trading curbs. These rules require trading to be suspended if an index falls by a certain percentage or amount. For example, if the Dow Jones falls 10% in a trading day, the New York Stock Exchange applies a trading curb that suspends trade for at least 1 hour. Stock market indices and analytical tools. A stock market index is an indicator that measures the value of a selected portfolio of securities or other assets. Indices are used to show the average movement of prices for a particular market, country, sector, currency, commodity, etc. These indices are closely followed as they are gauges that indicate the direction of the market over a given period of time. In addition, indices are often used as performance benchmarks against which to measure the return of investments of the same category as those tracked by the index. Investors usually make stock trading decisions based on analytical tools. Fundamental analysis attempts to assess a company's underlying value by scrutinizing its financial statements and business prospects, as well as macroeconomic factors that could affect the company's performance. By contrast, technical analysis focuses on the past performance of stocks. Analysts search for recurrent patterns, for example looking at peaks and troughs in stock price charts, that would help predict future trends. Part 6. Regulation and Supervision. Unit 20. Financial Regulation. Financial regulation refers to laws, rules and principles that govern various aspects of the functioning of financial institutions and markets. These are legal acts adopted by national legislatures or specialized authorities, increasingly based on recommendations or guidelines developed by international organizations, such as the Basel Committee on Banking Supervision. Certain categories of rules are applicable to various types of financial institutions. For instance, entry requirements specify the conditions institutions must fulfill in order to receive authorization to commence and carry on their activities. These conditions may relate, for example, to a minimum level of initial capital, or submitting a business model to be approved by the competent authority. In addition, persons to be appointed to boards of financial institutions typically must be considered to be fit and proper, that is, demonstrating integrity, competence and capability to perform their function. Banking regulation. Banking is among the most regulated sectors of business activity, due to its systemic importance and relation to the real economy. A key area of banking regulation is prudential regulation, which requires banks to hold sufficient capital against exposure to various types of risk inherent in banking. Capital allows banks to absorb potential losses so that depositors are protected. Different assets, for banks, mainly loans and debt instruments, carry varying degrees of risk. The higher the risk associated with the asset, the greater weight the asset receives, which means that banks must hold more capital for risky assets. The specific instruments that qualify as bank capital are also the subject of regulation. Apart from capital requirements, banking regulation sets down rules concerning portfolio restrictions, such as limits on large exposures. These are limits that the maximum level of a bank's exposures to a counterparty, or a group of connected counterparties in relation to the bank's capital resources. The object is to prevent a bank from incurring disproportionately large losses as a result of the failure of a counterparty. Most jurisdictions have established deposit insurance schemes to provide protection for depositors. Under such schemes, banks pay a premium to a deposit insurance institution, and in exchange, depositors have their deposits insured up to a fixed limit. An important function of deposit insurance is to prevent bank runs. That is a situation when many people withdraw their money in a short period of time, causing a bank to run short of liquidity. This in turn may lead to fire selling of assets by the bank and even insolvency. If a bank does become insolvent, normal bankruptcy proceedings may not be appropriate in a crisis situation. Therefore, some countries have adopted rules that regulate the resolution of banks, allowing authorities to manage bank failures in an orderly manner. Such regulation provides a means to restructure or wind down a bank that is failing and sell off its viable assets to other banks or investors. Securities regulation. One of the main objectives of securities regulation is the protection of investors. A key principle established in many jurisdictions to ensure a sufficient level of protection is the principle of suitability. It obliges investment firms to obtain relevant information about a customer, in order to assess whether an investment product is suitable for a particular customer based on his investment objectives, financial situation, knowledge and experience. Securities laws prohibit fraudulent activities of any kind in connection with the offer, purchase, or sale of securities. One example of such activities is insider trading, which refers to a situation when a person trades a security while in possession of material non-public information, defined as information that could substantially impact an investor's decision to buy or sell the security. Another type of fraud is market manipulation, which occurs when traders artificially affect the supply or demand for a security, causing its price to sharply rise or fall. It is usually carried out by spreading false information and deceptive trading activity. Securities regulation aims to foster fair and efficient markets. To this end, rules have been adopted regarding market transparency, pre-trade transparency, which allows investors to have access to quote information before trading, and post-trade transparency, which requires the dissemination of information about completed trades to the public. An example of regulatory measures adopted following the global financial crisis is the requirement that all standardized over-the-counter derivatives are to be cleared through central counterparties, CCPs, and that OTC derivatives contracts should be reported to trade repositories. In addition, the US has adopted the so-called Volcker Rule, which prohibits banks from engaging in short-term proprietary trading of securities for their own account. Insurance regulation. A key concept in the regulation of insurance companies is solvency, which is the ability of a company to meet its long-term financial obligations. For insurance companies, this means having sufficient assets to pay the claims made by its clients. In order to ensure the solvency of insurance companies, regulations define the required level of capital. During recent years, most jurisdictions have moved from fixed capital standards for their solvency regulation to some form of risk-based capital standards, such as the Solvency II directive in the EU. Some countries, for example the US, regulate the rates that insurance companies apply to their premiums. This may involve prior approval of rates by the insurance regulator, or establishing a system of rate bands allowing insurers to increase their rates by up to a designated percentage. In addition, many jurisdictions define rules concerning the content of insurance policies and forms, as well as the handling of insurance claims, for example procedural requirements and timeframes by which insurers must accept, pay or deny submitted claims. The vast majority of insurance transactions are conducted through intermediaries, such as insurance agents and brokers. Regulation typically sets down the conditions necessary to obtain a license, which may include training and exams, as well as aspects of their interactions with clients. There are also rules that provide clear conduct of business standards to ensure that insurance buyers receive proper advice, are protected from unscrupulous intermediaries, and have clear and accessible mechanisms to redress complaints. Unit 21. Financial Supervision. Purpose. Financial supervision is the oversight of financial institutions and markets, to ensure they are functioning in compliance with the financial regulations in force in a given jurisdiction. This serves the overall aim of safeguarding the safety and soundness of financial institutions, so that they are resilient against failure, and can avoid the potential harm resulting from the disruption to the continuity of financial services. Apart from checking compliance with regulations, supervisors assess and address risks emanating from individual financial institutions and groups of institutions. In addition, supervisory authorities themselves are often vested with certain regulatory powers, allowing them to adopt and enforce secondary or technical rules, for example through ordinances. Institutional arrangements. Depending on the country, financial supervision is organized according to several different models. A common arrangement is for the central bank to perform supervisory functions either directly, as for example in Italy, or by a supervisory authority under the auspices of the central bank, for example in France. Another approach is to have a separate authority or agency responsible for financial supervision, for example in Canada. The institutional structure of financial supervision also varies in terms of the integration of supervision of the three main sectors of financial services: banking, securities, and insurance. In some countries, there is one authority in charge of supervising all financial sectors, which reflects the fact that currently many large financial groups or conglomerates have subsidiaries operating in all three sectors. In other countries, there are supervisory authorities responsible for two sectors and authorities supervising a single sector. In recent years, the Twin Peaks model of supervision has been gaining popularity. This model is based on the separation of market conduct regulation, how firms conduct their business, design and price their products, and treat their customers, from prudential supervision. Under this model, financial institutions are dual regulated, hence the name. Licensing and approving changes in structure. Supervisory authorities are responsible for granting and withdrawing licenses that enable financial institutions to operate in their jurisdiction. Furthermore, supervisory approval is necessary for financial institutions for proposed changes in ownership, for example as a result of a merger or acquisition, or in the exercise of voting rights over a particular threshold or change in controlling interest. Supervisors also have the power to approve or reject major acquisitions or investments by financial institutions, measured for example as a percentage of total assets, in order to ensure that a given institution is not exposed to undue risks. On-site inspections and other supervisory tools. Financial institutions are required to provide extensive data in the form of regulatory reports to supervisory authorities. In order to verify the accuracy of such reports and to obtain further information, on-site inspections are carried out. They allow supervisors to assess the financial health of a given institution and gain insight on qualitative aspects of its operations, for example risk management. There are three basic types of inspection carried out at banks: a comprehensive inspection, which is an evaluation of all the bank's main activities; a thematic inspection, which focuses on selected activities of the bank; and a follow-up inspection, which is aimed at evaluating the fulfillment of measures adopted by the bank on the basis of a comprehensive or thematic inspection. In the case of banks, a key product of such an exam is a supervisory rating of the institution's overall condition, known as a CAMELS rating. This rating system was developed in the US and is commonly used by supervisors around the world. The name of the system is an acronym, which is made up of the following components: capital adequacy, asset quality, management quality, earnings, liquidity, and sensitivity to market risk. Bank supervisory authorities assign each bank a score on a scale of 1, best, to 5, worst, for each factor. On-site inspections absorb considerable resources and are thus usually conducted only once a year. During periods between inspections, supervisors carry out off-site monitoring, which is an ongoing analysis and assessment of financial health and exposure to risks. This is performed by supervisors based on regular, typically quarterly, reports, surveys, and other available information. Stress testing. In many jurisdictions, supervisors require financial institutions to perform stress testing exercises. Stress tests assess the consequences of hypothetical external shocks for financial institutions, and help to identify vulnerabilities and relevant remedial action. For banks, this may include, for example, the reduction of exposures to specific sectors or countries, or strengthening capital levels. Stress tests are typically conducted using a baseline scenario that is based on current economic forecasts, and an adverse scenario which projects a deviation of macroeconomic variables from a given baseline. Supervisory authorities may also perform complementary stress test exercises themselves, based on common scenarios for banks in their jurisdiction. These may be used to assess risk across financial institutions. Follow-up measures and sanctions. If a financial institution engages in unsound practices or breaches regulations, supervisors have powers to compel the institution to take necessary remedial action. With respect to banks, this may include restricting certain activities or requiring the institution to raise additional capital. Supervisors may also restrict or suspend payments to shareholders, restrict asset transfers, levy administrative fines, or revoke the institution's license. Some countries empower the supervisory authority to implement a restructuring and/or recapitalization of a failing institution. This may involve replacing or restricting the powers of managers, facilitating a takeover or merger, or transferring selected assets and liabilities of the failed firm to a newly established bridge institution. Unit 22. Offshore financial centers. Definition and characteristics. Offshore financial centers, OFC, are jurisdictions which specialize in providing financial services to persons domiciled outside those jurisdictions. They attract business thanks to a lax regulatory environment, low supervisory requirements and minimal information disclosure, and to low taxation or zero taxation regimes. Unlike in most onshore jurisdictions, there is usually no withholding tax on dividends or interest, and no capital gains tax. In addition, many tax havens exploit loopholes in tax treaties signed with other jurisdictions. This facilitates tax avoidance by individuals and entities. Furthermore, in OFCs the size of the financial services industry is disproportionately large compared to the size of the local economy. Another major feature of OFCs is the existence of financial secrecy laws, of which three basic types may be distinguished. First, laws are designed so that financial institutions are not allowed to provide personal information about their customers, unless certain conditions apply, for example a criminal complaint has been filed. The second type makes it legal to establish entities, trusts, companies, foundations or others, whose ownership and/or purpose is kept secret. The real or beneficiary owner of such an entity is typically hidden behind nominees, that is professional agents located in offshore jurisdictions who act as fronts to the real owner. The third type of secrecy involves jurisdictions creating barriers to cooperation, and the exchange of information with authorities in other countries. Geographical distribution. The term offshore derives from the fact that many OFCs are located on small islands. However, a number of developed countries have succeeded in attracting non-residents by offering economic incentives either throughout their jurisdiction, or in special economic zones. There is no definitive list of OFCs, as there are constant developments in rules and regulations applied by individual jurisdictions. However, advocacy groups promoting tax justice often classify OFCs into four main geographical groups. First, European countries such as Switzerland, Luxembourg, and the Netherlands. Second, the British Crown dependencies located in the English Channel, Jersey, Guernsey, Isle of Man, and overseas territories in the Caribbean Sea, Cayman Islands, Bermuda, British Virgin Islands. The City of London is also considered by many to be part of a British offshore zone, thanks to its unregulated eurodollar market. Third, the United States, which does not tax profits from investments for non-residents. Moreover, several U.S. states, for example Delaware and Nevada, offer incorporation that provides a high degree of secrecy. Finally, there are a number of small jurisdictions strewn around the world, for example on the islands of the Pacific Ocean, such as Samoa, Fiji, and Vanuatu. Types of services offered. Many offshore financial centers offer asset protection services to wealthy individuals. This involves transferring a person's assets onto an offshore trust, thus removing the ownership title of the asset from the original owner while keeping him or her as a beneficiary of the trust's assets. This is done to protect assets from creditors, inheritance tax, and legal processes such as asset freezes, forfeitures or nationalization. Because of the offshore secrecy laws and practices, it is extremely difficult for foreign law enforcement authorities to obtain information on the real owners of such assets. Incorporation in OFCs is often carried out through the establishment of shell companies. These are entities with no significant assets or ongoing business activities and no physical presence other than a mailing address. Although shell companies are sometimes formed to conduct legitimate transactions, they are frequently used to shield identities, hide illicit financial flows, or for tax evasion purposes. Large corporations frequently establish subsidiaries in OFCs for the purpose of transfer pricing. This occurs when a parent company and a subsidiary, or two subsidiaries controlled by a common parent, trade with each other. A crucial matter is the price that the parties establish for the transaction. If that price is not a fair market price, the procedure is abusive and illegal. By artificially adjusting the price for the internal transfer, corporations can shift profits into a low-tax OFC and costs into high-tax countries where they can be deducted against tax. Many banks use offshore financial centers for off-balance sheet activities. For instance, onshore banks established conduits in OFCs during the securitization boom prior to the global financial crisis. These vehicles were typically funded in onshore financial markets and purchased onshore assets. The conduit, such as a special purpose vehicle, and hence the onshore parent, benefit from favorable tax treatment in the OFC. Some offshore jurisdictions specialize in the formation of collective investment schemes. This is due to regulatory considerations. OFCs tend to impose few, if any, restrictions on what investment strategy the funds may pursue, and no limitations on the degree of leverage that investment funds apply. Recent developments. The outflows of money from advanced and developing economies into offshore financial centers have drawn public criticism in many countries. During the global financial crisis, with rising public deficits and painful austerity programs, the fact that large corporations were increasing their profits by eroding the tax base of governments was seen as unethical. Furthermore, the secrecy and opacity associated with OFCs create an environment in which money laundering and other criminal activities can thrive. In April 2009, Leaders of the G20 countries committed to tackling tax havens and mandated the Organization for Economic Cooperation and Development, OECD, to take action. The Global Forum on Transparency and Exchange of Information for Tax Purposes was established under the auspices of the OECD. In 2017, the Global Forum initiated the automatic exchange of a predetermined set of information on financial accounts, which has strengthened the ability of tax authorities to detect tax evasion. By 2019, around 100 countries had carried out automatic exchange of financial information, but notably, the United States was not one of them. Despite this progress, there are still a number of jurisdictions that continue to attract subsidiaries of multinational corporations with favorable tax regimes. One proposal that is gaining traction is to tax these corporations according to the real economic substance of where they actually do business, a system called unitary tax. This would require broad international consensus on changing the existing tax system, which could be difficult to achieve in the near future. Unit 23. Financial crime. Money laundering. Money laundering is the conversion of the proceeds of criminal activity into apparently legitimate funds. This is done by concealing or disguising the source of the money, changing its form, or moving the funds to a place where they are less likely to attract attention. The initial stage in the process of money laundering is called placement, when illicit funds are introduced, into the financial system. This is often carried out by dividing the money into less conspicuous smaller sums, which are then deposited into bank accounts, either directly or indirectly through the purchase of financial instruments such as checks or money orders. The next stage is known as layering, which involves the dispersal of funds so that they are distanced from their illegal origin. Many layers of financial transactions are typically used, and funds are moved through a complex web of accounts, companies, and countries. Afterwards, the funds re-enter the legitimate economy in the stage called integration. The laundered funds become available for investment in business ventures, real estate or other assets. Most countries around the world try to prevent money laundering by adopting rules that require financial institutions to verify the identity of their customers and to report suspicious transactions to financial intelligence units. For instance, in the US, all cash transactions, which include deposit, withdrawal, exchange of currency, or other transfer, in excess of $10,000 must be reported to the tax authorities. Counterfeiting. Counterfeiting currency is the manufacturing of imitations of genuine currency, or altering such currency to increase its value. Today this is mostly limited to counterfeiting banknotes, although there are still cases of forging coins, especially rare collector coins. In the Middle Ages, forgers were sentenced to death, they were boiled alive or burnt at the stake. Although such cruel punishment is not administered anymore, counterfeiting is still considered a serious crime, as it may potentially undermine confidence in a currency and have disruptive effects on the economy. In order to prevent counterfeiting, governments have applied security features to banknotes, which over the years have become more sophisticated. Banknotes in many countries include features such as watermarks, microprint, metallic thread and holograms. A more recent trend is the use of polymers, plastic, instead of the cotton paper that is commonly used. A portion of a polymer note is typically left clear to form a transparent window, which is extremely difficult to reproduce for counterfeiters. Polymer banknotes have the additional advantage of being 10 times more durable than paper notes. They are currently used by more than 50 countries. The UK introduced polymer banknotes in 2016. Financial fraud, accounting fraud, embezzlement, Ponzi schemes. Accounting fraud is the intentional misrepresentation or alteration of accounting records, which may involve overstating company revenues or assets, or understating liabilities. This is done to make a company appear financially stronger than in reality. It may occur by the use of false invoices, fictitious sales, or by means of more sophisticated methods, such as off-balance sheet accounting. It is sometimes used to make a company appear it has far less debt than it actually does, for example by moving debt to a company specifically created for that purpose, a special purpose entity or SPE. The opposite type of fraud, that is understating revenues or overstating expenses, also occurs and is indicative of companies who want to reduce their tax liability. Embezzlement is taking possession of funds or assets by a person into whose care they were entrusted. This may take the form of stealing merchandise or cash from an employer, which is difficult to prevent or detect if the transaction is a cash sale and not recorded. Another example is a financial advisor who embezzles the funds of his clients, for example by transferring them to his private account. To escape detection, perpetrators often steal only a small fraction of the total funds or assets that they controlled. A Ponzi scheme is an investment fraud in which alleged returns are paid to existing investors from funds contributed by new investors. The latter are often lured by the promise of receiving high or consistent returns with little or no risk. As there are little or no real earnings, Ponzi schemes require a steady stream of money from new investors to continue. The schemes typically collapse when the flow of new investors dwindles, or when a large number of investors attempt to cash out the promised returns. The most famous example of a Ponzi scheme in recent years was the fraudulent wealth management business run by Bernard Madoff in the US. He was sentenced to 150 years in prison after the fraud was exposed. Insider trading and rogue trading. Insider trading is the trading of a company's securities by corporate insiders who have access to non-public information about the company. The information would likely have an effect on the price of those securities, which would allow the insiders, or persons who are tipped by them, to achieve a risk-free profit. For example, information that a company is planning a merger often results in a surge in the price of that company's shares. Persons with knowledge of the planned merger, by buying the shares or call options on these shares, could make an illicit profit. This is illegal as it is considered unfair to investors who do not have access to the information. Trading by insiders is legal, providing that the confidential information has been made public, and the trades have been reported to the competent authorities. Rogue trading takes place when an employee of a financial institution makes unauthorized transactions in financial markets. Such traders typically abuse their position by making large speculative bets, usually by means of options or futures trades. As these are high-risk transactions, they may generate huge losses for the institution where rogue traders work. The most famous, or infamous, rogue trader was Nick Leeson, whose option transactions caused the collapse of Barings, the UK's oldest investment bank, in 1995. Part 7. Recent developments. Unit 24. The Global Financial Crisis. Subprime loans. The origins of the financial crisis can be traced back to the early 2000s in the US, where an environment of low interest rates and rising house prices contributed to the formation of a housing bubble. The most dangerous aspect of this bubble was the rise of subprime mortgage loans, granted to persons with a poor credit history, often with very low income. This type of lending by banks and their subprime affiliates lacked proper supervision, which was part of a broad tendency to deregulate the financial industry. When interest rates started to grow considerably between 2004 and 2006, homeowners began to default on their mortgages and lose their homes due to foreclosure. These defaults would have major repercussions across the financial system. The role of securitization. Through the process of securitization, the mortgage loans were sold to investment banks, which pooled the loans into debt securities, mortgage-backed securities, or MBS. In order to improve the investment grade, the lower-rated tranches of MBS were combined with higher-quality bonds and sold as a new security, known as collateralized debt obligations, CDO. Although these securities were inherently risky, they were largely rated AAA by credit rating agencies. This was due to flaws in rating methodologies as well as the considerable fees that the agencies received for providing the desired rating. The CDOs were purchased by banks, pension funds, insurance companies and other institutions around the world because they appeared to be safe, while providing higher returns in a world of low interest rates. However, these buyers failed to carry out their own due diligence, and thus did not grasp that they were acquiring toxic assets. When mortgage delinquencies spread in 2007, the underlying assets, MBS and CDOs, began incurring losses. This led to mass rating downgrades, which in turn forced investors to sell off their holdings because they had lost their investment grade status. The trouble then spread to banks, which had large holdings of securities tied to subprime loans. Lehman Brothers, a large investment bank, was particularly vulnerable because of its high degree of leverage. The bank's bankruptcy in September 2008 led to turmoil across the financial world. It deepened the growing mistrust among banks, reluctant to lend to each other because of the fear of counterparty risk. The resulting credit crunch was made worse by the fact that banks hoarded liquidity to cover any potential losses on their own books. Lehman's collapse is considered to be the apex of the global financial crisis. Too big to fail. A major reason why banks and other financial institutions engaged in risky activities in the pre-crisis period was the implicit guarantee by the U.S. government that it would intervene, at taxpayers' expense, to prevent the failure of such institutions. This guarantee stemmed from the belief that the failure of a large systemically important institution would cause significant disruption to the financial system and the economy. The potential consequences of such a disruption are judged to outweigh the cost of supporting a failing institution. This is known as the too big to fail concept. The U.S. government decided not to intervene in the case of Lehman Brothers, but a classic example of too big to fail was the bailout of AIG, the largest insurance group in the world at that time. AIG had accumulated huge losses resulting from the sale of credit default swaps, CDS, which were bought by financial institutions around the world to insure against default on mortgage securities. When the defaults did happen on a mass scale, AIG's failure would have triggered unprecedented losses for CDS counterparties with accompanying chaos on world markets. For this reason, the U.S. government stepped in with an $85 billion loan, which in effect amounted to a temporary nationalization of the insurance giant. Policy measures and institutional reform. To address the liquidity crisis following Lehman's bankruptcy, the Federal Reserve and other central banks around the world expanded the availability of credit to financial institutions, reduced the main interest rates and applied a policy known as quantitative easing. This is an unconventional type of monetary policy where central banks create money by buying debt securities from commercial banks. Quantitative easing is designed to stimulate the economy, as it encourages banks to make more loans. Another measure enacted by the US and European governments involved capital injections, which were meant to give banks receiving the funds a buffer against further losses, supporting lending and bolstering confidence in the financial system. In addition, some governments purchased toxic assets from banks, in order to dispel uncertainty regarding the quality of bank balance sheets. The global financial crisis demonstrated the need for an overhaul of banking regulation. The Basel Committee on Banking Supervision, the international standard setter for the prudential regulation of banks, adopted a revised set of measures, known as Basel III. These measures called for banks to hold more and higher quality capital to increase their ability to absorb losses, while reducing the incentive to take excessive risks. Systemically important banks are required to hold even higher levels of capital. The Basel III reforms were implemented into national law in major financial jurisdictions, such as the US and EU. During the financial crisis, many people wondered why the various authorities responsible for financial supervision and financial stability had not warned about the potential consequences of the subprime bubble and securitization boom. The answer was that supervision was focused on individual financial institutions, that is microprudential supervision, while not enough attention was placed on the impact of developments on sectors, markets and the financial system as a whole. To fill this important gap, new macroprudential oversight institutions were established whose role is to monitor and mitigate systemic risk in the financial system. Unit 25. The LIBOR Scandal. LIBOR, Purpose and Usage. The London Interbank Offered Rate, LIBOR, was a set of interest rates at which banks borrowed funds from one another in the London interbank market. The rates were produced daily for a range of currencies and loan maturities ranging from overnight to 12 months. Since its introduction in 1986, LIBOR grew in prominence, eventually becoming the most widely used reference rate for short-term interest rates. This means that LIBOR was a point of reference, a base rate, for establishing interest rates on variable rate loans, for example mortgage loans, credit card loans. In addition, LIBOR was the primary reference rate for derivatives used for hedging interest rate risk, for example interest rate swaps and futures. In loan and derivative contracts, interest rates were typically expressed as LIBOR plus X, where X is the premium charged for individual borrowers. For example, the interest on a loan was quoted as 3-month USD LIBOR plus 250 basis points, or 2.5%. This allowed for easier standardization of financial contracts, especially the floating rate component of the contract. LIBOR was also treated as a barometer of the health of the banking system. The spreads between LIBOR rates and other benchmark rates often reflected changes in risk premia, which increased during periods of uncertainty. How LIBOR was calculated. The calculation of LIBOR rates used to be carried out through a daily survey of a group of banks called panel banks. These are large, international banks which submitted, for a given currency and maturity, the estimated rate at which they could expect to borrow funds from one another. Once the banks submitted their rates, LIBOR was calculated using a trimmed arithmetic mean, that is the highest and lowest 25% of submissions were excluded, while the arithmetic average from remaining contributions produced the LIBOR rate. The calculation was not based on actual loan transactions because not all banks borrowed substantial funds for each maturity every day. As a result, the process of rate submissions was subjective and discretionary in character. Considering also the lack of formal supervision over LIBOR until recently, the process was clearly prone to manipulation. This was confirmed when cases of misconduct by the panel banks were discovered. LIBOR fraud. Between 2005 and 2007, a number of LIBOR panel banks systematically inflated their borrowing cost estimates. This was related to the bank's derivative trading activities. They held assets and liabilities sensitive to LIBOR, and consequently even relatively small moves in the final value of LIBOR resulted in daily profits or losses worth millions of dollars. Some of the LIBOR panel banks thus concluded that they could, illegally, make more money if they overstated their estimated borrowing costs. This pushed up the LIBOR rate and consequently allowed them to increase their profits on derivatives linked to the rate. Banks did this individually but also acted in collusion to alter LIBOR rates. After 2007, when the global financial crisis intensified, the opposite type of rate rigging took place. This was in a way related to the transparency of LIBOR rate submissions. The submissions of individual banks were published daily, alongside the final LIBOR rate. At a time when the interbank market was largely frozen and access to funds was limited, a bank submitting higher interbank borrowing rates than its peers was viewed as having a higher credit risk. Several LIBOR panel banks thus started to regularly understate their borrowing costs to improve their reputation in the market. But when other indicators of bank health were regularly showing warning signs during the financial crisis, the reliability of LIBOR was publicly questioned. In 2012, evidence surfaced in the press which showed that LIBOR manipulation had been a frequent phenomenon. Regulatory and criminal agencies in the US, UK, and other countries opened investigations, and allegations that the regulators were aware of the ongoing fraud led to hearings in the US Congress and UK Parliament. In disclosed court documents, the massive scale of the fraudulent LIBOR fixings became known. The LIBOR panel banks were described as a cartel by one of the traders involved. Several banks had to pay significant fines, reaching $1.5 billion in one case, for participating in the manipulation, while individual traders have been charged with conspiracy to defraud. In addition, the LIBOR panel banks faced private lawsuits from persons or institutions claiming financial losses as a result of the fraud. Phase out. The LIBOR scandal caused public outrage around the world. It came as a shock that it was so easy to manipulate a reference rate to which hundreds of trillions of dollars of securities and loans were linked. In the UK, an independent review of LIBOR was carried out and the resulting recommendations served as the basis for a range of reforms. Notably, an autonomous and regulated entity replaced the British Bankers Association as LIBOR administrator in 2014. However, despite the improved integrity of the rate submission process, the shrinking volume of unsecured interbank transactions meant that LIBOR's credibility was no longer tenable. As a result, it was decided that LIBOR would be gradually replaced by alternative rates based on reliable market data. From the list of 10 LIBOR currencies, only US dollar rates for several maturities continued to be published by 2022. The UK's Financial Conduct Authority announced that publication of the last remaining LIBOR rates would permanently cease on 30 June 2023. LIBOR replacements. During the transition away from LIBOR, a number of jurisdictions introduced new rates, designed to reflect actual lending transactions. The US launched the Secured Overnight Financing Rate, SOFR, based on the average rates that large financial institutions pay each other for overnight loans. A similar type of benchmark rate was introduced in the UK, Sterling Overnight Index Average, or SONIA, and Europe, Euro Short-Term Rate, abbreviated as ESTER. While SONIA and ESTER are unsecured rates determined by underlying interbank money market trades, SOFR is a secured rate underpinned by repo transactions. Unit 26. From Bailout to Bail-in. Bailouts and moral hazard. During the global financial crisis, the governments of the US and other countries provided support to financial institutions considered too big to fail. Banks and other institutions were recapitalized using public funds, which saved them from bankruptcy. On the one hand, government bailouts of banks and other institutions prevented a domino effect that could have led to a further deterioration of the crisis. However, there were also legitimate concerns that cast doubt on the use of this type of intervention by governments. One important argument was that banks and bankers made enormous profits in the run-up to the crisis, but when they ran into trouble due to their reckless behavior, the losses were socialized, that is, paid for by society, taxpayers. Another reason why bailouts were viewed critically was that the expectation of government intervention to rescue failing banks creates moral hazard. This is a situation where financial institutions have an incentive to engage in risky types of business, knowing that the burden of potential losses would be borne by others. Moral hazard encourages excessive risk-taking, which was a major cause of the global financial crisis and which could easily trigger a new crisis. The Eurozone debt crisis. Government support provided to banks was one of the factors that contributed to the Eurozone debt crisis. It began in late 2009 when it was revealed that Greece's actual budget deficit and debt-to-GDP ratio were much worse than had been officially reported. Soon afterwards, other euro area countries experienced problems with very high levels of sovereign debt that became too expensive to refinance. In the case of Ireland and Spain, banks had financed a housing bubble, which burst under the impact of the global financial crisis. As a result, banks suffered heavy losses and the governments in both countries decided it was necessary to bail out the banks to prevent their collapse. The problem was that the Irish and Spanish governments could not finance such an intervention on their own. They needed a bailout themselves to avoid possible default, which could have led to a breakup of the Eurozone. The relation that developed between banks and some European governments has been described as a vicious circle. Governments borrowed money from banks by selling them bonds. The value of these bonds dropped significantly when the government's debt and budget deficits reached alarming levels, hurting the creditworthiness of these countries. This in turn affected the banks in several ways. The value of their bond holdings depreciated. Some sovereign bonds could no longer be used as collateral in the interbank repo market, banks' credit ratings were downgraded, and finally, banks' share prices tumbled. All these factors made banks vulnerable and likely to request financial support from governments. If such support was granted, it increased the level of government sovereign debt and further deteriorated their fiscal position. This would force governments to request assistance from bailout funds. How bail-in works. In order to avoid the bailout of financial institutions and of governments supporting such institutions, bail-in has emerged as an effective and socially preferable alternative. Bail-in is a legal procedure which gives a designated authority the power to impose losses on the bondholders, that is creditors, of a distressed financial institution. This is carried out by converting existing unsecured debt issued by the financial institution into equity, shares, which can then be added to the institution's capital. The designated authority may also decide to write down a certain amount of debt, that is, reduce its value so that the holders of debt cover the institution's losses. As a precondition for bail-in, existing equity shares absorb losses first. When bail-in is applied, it follows the priority used in a liquidation, that is, holders of subordinated debt incur losses, followed by holders of senior debt. If this is not sufficient, deposits not covered by deposit guarantee systems are also bailed in. The whole process takes place rapidly, which allows the troubled institution to continue functioning as a going concern and provide essential services to customers. The key advantage is that private investors bear the costs of potential failure, which creates a strong incentive for financial institutions to properly manage their risks. Bad bank and other resolution tools. Bail-in is one of the possible tools used for the resolution of banks, that is, the restructuring or winding down of a failing bank in an orderly manner, conducted by a designated authority. It is important to prevent the disorderly bankruptcy of banks, especially large banks, due to the potential contagion effect that could destabilize other banks or even the financial system as a whole. While bail-in is applied to banks whose main problem is inadequate capital, there are also cases when a bank is burdened by troubled assets. One way to address this problem is to segregate the institution's bad assets from the good ones. This is when a bad bank is established. A bad bank is not actually a bank, but an entity, privately owned or state-owned, that usually operates as an asset management company. It is set up with a predefined lifespan, during which the bad assets, for example non-performing loans or foreclosed properties, are to be sold off in order to recover as much of their value as possible. Meanwhile, the good assets remain with the good bank, which can continue to provide banking services, but is usually temporarily nationalized or sold to another bank. The designated authority may also sell the troubled bank to another financial institution, or it may set up a bridge bank. This is a temporary bank created to maintain banking operations until a permanent solution can be found, which is the sale of the bridge bank to another private sector institution.